Good day, fellow investors. We already did a few of the cheap S&P 500 stocks. Today we're going to do another 15 that I summarized from looking at every stock in the S&P 500. I will give you 3 categories. Leave it to pension funds is one. Is the bet worth it? 5 stocks there. And interesting buys, 1 is, and 2 certainly to follow stocks from this list. Now, smash that like button if you enjoy such analysis videos so that you support the channel and I do more. Plus, if you think that I have forgotten some of the S&P 500, please elaborate in the comments on the thesis for that specific S&P 500 stock to give value to the readers. Those readers and you, please like those interesting comments, suggestions, and I'll do definitely the most liked comments to see the risk and reward of the positions. By the way, I have updated my research platform. We have now 5 interesting value investment buys, all the theses one by one, so feel free to check that if you're interested in value investing global opportunities. Let's immediately start with the list. Southern Utility is the first one that isn't that cheap, but utilities are a little bit in a negative sentiment. If you look at the stock, it is a compounder. It has been just compounding, churning that return over time, paying a good dividend yield, and as the dividend yield and the dividend increased, so did the stock follow. Over the last few years, however, the stock didn't do much. A little bit the pandemic, a little bit increasing interest rates, but the company is set up to just keep on doing what it has been doing, increasing the dividends, paying those dividends, and investing for higher and higher earnings alongside inflation protection that should come from selling energy. I've looked a little bit at the company. They are guiding for flat, let's say, revenues and earnings. They are investing all in state-regulated utilities, so everything will depend on that, let's say, deal with the state going forward. They are investing in maintenance, something in growth, 11 billion, and other things that they need to invest. Now, if I look at their debt, it is significant with almost 60 billion of debt, which is like a few small countries have together. Over the last years, that debt has been increasing. The interest expense, as interest rates went up, have almost doubled, even if that increased just 50%. So over time, despite the long maturity, which is okay, that should be a smaller negative, and that can also explain a little bit here the stop in the stock price related to higher interest rates. However, nothing bad with this stable company. I have looked at Berkshire's letter. There is a big chapter on utilities and how Buffett isn't happy with what's going on there. You can pause here, read a little bit about what Buffett is saying related to regulation and everything, and how it is uncertain how utilities will get out of this. With a 4% dividend yield, nothing wrong with it, but also nothing spectacular. There should be, if the contract with the state there keeps on as it is, it should give you some, let's say, protection for inflation. If there is economic growth, demand, investments, all well, they should keep on compounding, but apart from the dividend, don't expect stellar returns. However, the risks that Buffett mentioned, where states break off those contracts, are there, are slightly increasing, and I don't know how will that develop over the next decades. So yes and not, but I think for us retail investors at these levels, it's better to leave this to pension funds. Another stock that is usually very much requested in your comments is PayPal. And I've done a few videos telling you how it wasn't cheap at 126, not a bargain, and then also how it wasn't cheap 8 months ago, and it didn't do much since then, but it is down a little bit. So for now, I was right to keep avoiding PayPal. Let's see whether now it is a better situation that the stock has gone from 300 to 58. If I look at what is their goal now, their goal is to build on what they have, on the people that have, on their name that have, invest in profitability, cost savings, and lo and behold, from now on they will include stock-based compensation in their non-GAAP results. Just from now on. They didn't include it till now, and you'll see why. Now they're focused on, let's say, profitable growth, but I don't see that much traction. They paid a lot for that Braintree acquisition, trying to implement those into their system. But if I look at what's going on, okay, it is something, but also not that great of a business. They are still losing on their eBay connections, but they are making some cash flows around 4 billion, which is interesting compared to the 60 billion market capitalization, a P ratio of 15, nothing wrong with it. But if I look at the profits, there is the stock-based compensation compared to the profits, and then they are saying they are doing a lot of repurchases, and I see those 5 billion, 5 billion, a little bit less than 5 billion, 4 billion over the years, huge repurchases, but the number of shares went down just 10%. And if there is no increased traction in the business, it is not smart to do repurchases at higher prices if your business is deteriorating. However, the question here is the bet worth it? And I don't think that the focus here is on shareholders. The focus here is on management. They will keep doing acquisitions. They will keep doing whatever they can to keep the business bigger, more activity, more this or that. But do I know what will happen? For now, they are not getting any traction compared to the activity and the costs. PayPal is last decade, and I'm feeling that all these new technologies are here to make transactions frictionless, cheaper, which will be a big headwind for PayPal over the next decade or two. You want to use your phone, pay minimal transactions, zero transactions, and that's not how PayPal makes money. When it comes to answering the question, is the bet worth it? You have to think, okay, what is the risk? What is the reward? If there is further deterioration of the business, if the buybacks are not effective, then it is a negative and you can lose another 50% from here. If it gets somehow miraculously traction, they nail the next trend, which is unlikely, I think, then you can double, triple your money. But out of 10 similar situations, I think that 7 will be negative, 2 will double, triple your money, and 1 will be a 5, 10x. And at the end of such scenarios, you don't come up with much. So it is a bet that I don't think we as retail long-term value investors should be taking now. Another interesting cheap stock is Altria. We did a video, I think 5 years ago, discussing how it is interesting with the high dividend yield. It's a cash cow. But since then, the stock is there, the dividends are there, the dividends have actually increased, the yield now is 10%, and I think that what the management is doing here is really a miracle, and they keep squeezing those huge dividends and paying those dividends. Now, personally, when it comes to Altria, I prefer businesses that have long-term positive structural trends, because when you make a mistake and mistakes are completely normal when it comes to investing. If the trend is positive, the mistake can be much less, let's say, costly. But in a negative trend, if you make a mistake, then the mistake can be very, very costly. And can I see 10 years forward into the earnings here? If they keep paying those huge 10% dividends, you get your 10 years of dividends, reinvest, compound, you get your money back in 6-7 years, and then whatever happens with Altria, you don't care. So from that perspective, there could be a margin of safety, but the question is, how long will this last? Litigation with their vaping will get resolved only in 2025. So I don't think I am the person to judge this. Very interesting for dividend holders. Will there be the demand for the next 5 years? If it degrades, it will degrade slowly. They might hit something with this vaping, more profits. So there is certainly market, there are cash flows. Nobody's entering into that industry now. It's pretty stable, except for the vaping, but it will deteriorate, but likely profitably for the company. Their capex is very low. So the cash cow is still a cash cow to be milked, and see how the dividends, even if they deteriorate a few billions a year for the next 10 years, it could still be a positive. Compare this to other options. As I said, I just prefer structural trends, but this could be an interesting value investment for those that are looking for such high dividend yield investments. Now, Ford, I've discussed Ford, and I'm telling you that you can buy maybe car companies in a crash. Since I've discussed it 5 years ago, the stock didn't do much. I got my shares of Sven You're Stupid when the stock passed 25, but that quickly reverted from that bubble, and now we are back to normality. There is a dividend yield, but I would prefer to focus on car stocks if you must in recessions, in bad times, European times, and then you can really make some money there. But leave it to pension funds. There is no magic in the industry, highly competitive, consumer preference based, and of course there is no magic except Elon Musk's magic, but Ford I don't think will have Elon Musk's magic on its side. Now, Kroger. This is a stock that I discussed 6 years ago, telling people how it will beat the S&P 500. Also, 3 years ago, how you can get a good return of around 8% by buying this. Fortunately for me, Kroger did 106% over the past 5 years. The S&P 500 did 86%, and now don't think I'm a genius. Here is a video with 15 of my mistakes where I actually lost money. So just to counter that, I told you so over time. Going back to Kroger, now the stock is up. It did well. Back then it had a P ratio of 10. Now it has a P ratio of 20. The dividend yield is down. Business is stable. Their Albertsons merger will likely falter. The thesis is that they have a good business. It is a good business, but from a P ratio of 20, again, leave this now to pension funds. You will likely get a good return, 2%. There will be good, there will be bad times, and that when the market is pessimistic about it, that's the time to take advantage of those returns from a good business that you likely shop if you're from the States very often there. Now, fairly priced, nothing special, leave it to pension funds. The stock did its job. DuPont is another cheap stock. Now, not cheap if you look at the P ratio, but cheap if you look at what it has done over the years. The market isn't excited about it. Net sales even going down since 2022. There is that, and the guidance is for more stability. However, this as a chemical business, you want to look at these businesses in recessions, in downturns, not now. And therefore, like the stock we discussed with Lyondell, these chemicals, some look better on evaluation, some look more expensive, but leave it now to pension funds, and only when it looks very ugly, recession's time, then it is perhaps interesting to look at for us retail investors. Even if, when it comes to real recessions, there will be much better bargains there. Therefore, just leave it to pension funds. Another chemical, P ratio is just 8 here, and that is because of some one-off items. But look at this. They just purchased 11 billion from DuPont, so they buy something DuPont is selling, and this is the story with chemicals. What they bought is primarily used by automakers, and you can see here how their goodwill went up, their long-term debt exploded due to the acquisition, interest expense went up significantly, earnings before taxes actually didn't go up, it went down. And now this company depends on the economy, depends on the automotive industry. If there is a recession, then this acquisition that they made will mean very, very ugly things going forward. Is the bet worth it for this dividend, etc.? Maybe they can, for a $16 billion market capitalization, now that they have higher revenues and everything, turn it around. But I think DuPont dumped what they had pretty quickly here, and the smart ones were here, and we'll see how this develops. Therefore, it is not a bet worth taking now, despite the market liking it. But if there is, again, any sign of recession like we have seen a year and something ago, scare, then this will go lower and lower. HPQ, another two cheap stocks. Let's start with one of the things that I'm allergic to, and that is my printer. I simply cannot get on good terms with printers. Fortunately, I don't print that much anymore. But the stock has doubled from the pandemic lows. The P ratio is very low. The dividend is there. The market cap 30 billion. However, if we look at revenues and numbers, those are down. People are not at home that much, so not buying printers, but still the company is profitable, making money and returning money to shareholders through dividends and buybacks. However, if we look at the growth, okay, negative. If there is a recession, it will go down again. And here I want to discuss something that is very important with value investing now. You're looking at these numbers, okay, revenues are declining, not that stellar, but then you say, Sven, this is a good business trading at only a P ratio of 8 with a price to free cash flow of around 10, let's say, at these market capitalization. And now let's discuss this. Okay, this is cheap. Okay, they are investing, they need to keep things, but they are paying a dividend yield, they are doing buybacks, and they will have another 3 billion for that going forward. And now the question is, here we come to the value investing issue in these markets. Yes, the price earnings ratio is cheap, but who is going to push this P ratio from 9 to 18 so that you double your money? Nobody. So this is a small part of the S&P 500. It's not the hot part of the S&P 500. Value investors have been killed. Active investing has been destroyed. And with the little money left, they are not going to buy a P ratio of 9. They're going to buy a P ratio of 3 that we'll discuss in a moment. So it is an interesting one to follow. Over time, over the cycle, you can have some good returns there. You're definitely buying something cheap, but then again, in a recession, it should be much cheaper. Will there be a recession? I don't know, but if that happens, you double down, and over the long term, you should do okay. However, keep in mind their revenues have been ups and downs, but their net income did decline over the last decade. So it is not as profitable as it was printers, things like that, PCs, very highly competitive environment. Hewlett Packard Enterprises, and they put AI immediately in the second slide of their presentation. But then again, if I look at net revenue down 14%, they are also profitable, P ratio around 12. Some things are doing a little bit better, some things are not doing as well, but I still expect to generate cash over time, to use that money to do repurchases, paying dividends. And again, interesting to follow, but who will pay more? Who will bring this P ratio to 24? And the dividend, just the dividend, is not enough to justify something like this. And then again, when ugly times come, recessions, Europe crisis, then it might be interesting if you don't have better opportunities. But let's say interesting. Speaking of P ratios of 3, 4, let's talk about Warner Bros. Discovery. We already discussed this a year ago when it was spin-off value oversold. We bought for the former YouTube portfolio, we sold, made some money, and now the stock is much lower from where we closed that, and it looks like a forgotten stock. 21 billion market capitalization. Let's look at what is going on there. Warner Bros. Discovery, and they said they will make free cash flows, and they made 6 billion of free cash flows last year. Compare that to 21 billion market cap. That's a price to free cash flow of 3.5. So suddenly those P ratios of 10 are not that cheap. This is 3.5. This is insane. And they are using that money to repay their debt levels. They have repaid about 12 billion since the merger. So they created 12 billion of value since that merger and spin a few years ago. So nothing wrong with this, doing what they said. And they have huge debt profiles, but 100% fixed rate debt. And with 6 billion of cash flows, they can clean off that debt year by year, no worries. And I've looked a little bit at the last conference call. They are taking on Tom Hanks, they're taking on Tom Cruise, George Clooney, new movies, investing, and trying to revive that long-term power that they have with their IP, with their brands. They are building out this max streaming that I don't know how smart that is given the competition, the Netflixes, the Disney Pluses out there. However, they are working on that. Wonka, we went to see it with the family. It was a very nice, enjoyable movie. And if I look forward, they still believe the 60% cash conversion is doable. If they have a few good movies, even if not, likely cash flows will be for 4 to 6 billion over time, which is very, very cheap. And then when they get to 3 times EBITDA, so 30 billion or less, so we still have, let's say, 4 years of that focus, and that's why the stock is going down, because nobody cares. If I look at the conference call, 1, 2, 3, 6 analysts, so forgotten spin-off, the stock is going down. All those index investors that are automatically buying the S&P 500 are buying more of the Nvidias, and as this stock goes down, the market cap goes down. These index funds do not buy more, they actually sell this to adjust their weight there, and therefore the stock is forgotten. The free cash flows are very, very high. Yes, there is some debt, but again, 30 billion at a fixed rate is a billion and something of cost. That should do well. And if they just do 5 billion going forward, that's a price to cash flow of 4, very cheap. And when they start using, let's say, 3 billion to repay debt and 3 billion to buybacks on this, then the P ratio could go to 10, but we might wait a year, 2 years. However, it's already an interesting place to position oneself. Now, if they have 2 years of good movies, P ratio 15, that's 60 billion, which is a very interesting proposition now. What's the downside? Now, with their brands and everything, look at how much Netflix is spending on their content. 20 billion a year. Compare that to the market cap of Warner Bros. Discoveries. Why wouldn't Netflix offer 40 billion, take it over? With 40 billion, which is 2 years of their spending, they get their content, profitable content, for the rest of what they are doing. Very, very interesting. We can go deeper here and you can have a strategy. You buy now at 9, let's say it goes to 6.5. You just increase a little bit your position, and I think this would be a very interesting situation for someone that has 15-20 businesses in his portfolio. You invest 2%. If it goes down, you bring it up to 4%. If then the stock goes from 9 to 6 back to 9, you make 2%, you sell that 2%, you make a 1% profit on your portfolio. If you have 20 positions like that, that's a 20% return over a year, just from that fluctuation in the stock price. Plus, if Netflix takes it over, if things improve, if they start to do buybacks in a year or two, this could be a very, very interesting return going forward. We might keep watching it on YouTube. I'm not a fan of investing in intangible assets like film industry personally, so it doesn't fit my own, let's say, characteristics, but it is a very interesting business to look at now. Another company, cheap one, eBay, P ratio just 9, but the dividend yield isn't 10%, it's just 2.13%, which means they are investing in growth, trying to get their traction. They need to beat Amazon. And I don't know whether this AI trend or something, like PayPal, they have had their position in the market. They have lost their position because they are stable, everyone else is growing. And yes, no growth here in the results. They are doing those buybacks and everything, but if you don't have growth, then buybacks are not the smartest thing they do. They have to do these investments to keep their position stable. And again, this is again a bet question. Is the bet worth it? Am I being paid enough while I'm waiting? In this case, I don't think so. WBA stock, we discussed it already. The trend has been clearly negative. They have finally cut the dividend as it was expected. And here I want to discuss how a dividend cut is never priced in. When the cut happens, the stock goes down. They are discussing their challenging environment, but that's all that we see here now. They are trying to do cost savings. They have cut the dividend, but investments to grow pharmacy and healthcare, for now, the clear trend is that they are lying. There is no accumulating consumer pressures from inflation and depleted savings. The economy is booming, people. So it is a structural issue to the business model. Therefore, the headwinds are consumer spending pullback and, yes, shifting behaviors. And if that continues, no matter what's going on here, this will not end up good. Maybe someone will take it over, but again, the activist investor to take it over here are gone. They need much more to invest in this. So it's not a bet I would like to take. Leave it to pension funds or some activist investor that comes in. Mosaic fertilizers, and this is a clear cyclical. Good times, bad times, exuberant times, bad times, great times, bad times, great times, and now going towards bad times again. If you can nail the bottom of the cycle, you can make really, really good returns with these fertilizers. Don't get confused by this. P ratio is going up as the cycle reverts. Potash, phosphate, Mosaic, Fertilizantes, Brazil. And you can see here that those prices have been going down, and therefore also the stock is following prices because you can estimate their profits depending on prices. There is an elephant in the room. 2026, Janssen is coming on, which would bring more supply to the market, And that's something to keep in mind, as we can have 1-2 bad years for the market, as this is a 100-year long-term project. They are in their position, they cannot influence the market, they are price takers, not price makers. And you can see here just a $10 price sensitivity lowers 70 million in adjusted EBITDA. So if the price goes a little bit lower, quickly this gets to we are not making any money like 2019, and that is the time to look at fertilizantes. Another cyclical, international paper and packaging. P ratio is higher, but the dividend yield is 5. They say the industry is in positive growth, some savings, but then again, you can see the cyclicality here and lower numbers compared to 2022. The free cash flow is going down. So we are now, let's say, fairly priced compared to the market capitalization. They will likely keep the dividend, but you can again see the right time it is to buy this in very ugly times, recessions. For now, we are not yet in. If we get in, this will go lower, and that will be the time to look at it. Another packaging company, Packaging Corporation of America. The market is exuberant about this. They have, better numbers than others, but they are in the same industry, have been compounding a lot, very good. But then again, wait for uglier times. Another cheap stock, VICI Properties, P ratio of 11, dividend yield of 5.72%, has been struggling lately, but it did something 50% up since 2017, but keep in mind this is from a bankruptcy when they spun off this property. They have been investing like crazy, growing EBITDA 322%, keep in mind the stock just 50%. And what they are doing a lot of acquisitions, going away from the Caesars into many other properties, 10 trophy assets on the Las Vegas Strip. But if I look at the cash flow per share, because they issued a lot of debt, because they have more than double the number of shares outstanding, issuing equity, the cash flow per share went up from 137 to 215, which is just inflation. So interesting. I don't like these crazy leverage equity and debt companies, because once the machine stops, it gets very, very ugly, like we have seen in 2009. I'm not forecasting it, but it's not something that I would sleep well. No matter the 5.7% dividend, it's not worth it for the risks taken. Maybe it will give you protection from inflation, but leave it to pension funds. Check my research platform for my value investments, my list. Thanks for watching. I'll see you in the next video.